My second time here at ISET, which is one of the top universities in Georgia. So I think it's quite well known, I think most of you are quite aware that developing Asia, in particular East Asia, but also Asia generally, suffers from this dichotomy. On the one hand, we have a very dynamic, right, real economy, especially a dynamic export-oriented manufacturing sector. Companies like Samsung from Korea, where I'm originally from, and all these and Toyota, and all these world-class manufacturing companies, dynamic real economy on the one hand, but at the same time, we have a relatively backward financial system. Many of you can name a world-class Asian manufacturing company, but I'm sure that none of you can name a world-class Asian bank, right, or other financial institution. So there is this clear dichotomy between a very dynamic, world-class, real economy and the relatively backward, underdeveloped financial system, certainly well below or much less developed than New York and London and all these global financial centers. So a question you might have immediately at this point is, this is a well-known issue. Asia has a dynamic real economy, a backward financial system. So why are we doing this now? Why are we revisiting this issue at this point in time? Especially when, again, as most of you are aware, global financial crisis gave finance a really bad reputation, a bad name, especially in advanced countries, right, such as US and UK and other rich countries, right? Because the immediate cause, right, immediate catalyst of this global financial crisis was, in fact, very sophisticated financial innovations, right? And mortgage-backed securities, CDOs, and all these fancy sophisticated financial products that even financial regulators, right, could not keep on top of, could not handle, could not keep on track of. So there is, in the rich countries, this notion that there might be, there might be too much finance. So in the US, but also in other rich countries, there's been a lot of new regulations, right? Since the global financial crisis, there is this fairly widespread notion that too much finance, too much financial development is a bad thing. So that might make you wonder again, why are you guys then doing this? Because I think we have to be very careful here, because this notion of too much finance, that might be true for New York, right? Wall Street, London, the city, and all these, Zurich, right? Switzerland, all these financially advanced countries in US and Europe in particular. But Asia for sure is not New York or London. Other than perhaps Singapore and Hong Kong, for the most part, again, our financial systems are much less, right? Much less developed than that of the rich countries. So financial development, in other words, financial development in Asia means something completely different, fundamentally different than financial development in the rich countries, in the US. So it's important, I think, not to get confused, right? Not to bring the realities of New York and London to the realities of Asia, because these are, yes.
What about Tokyo?
Japan's also Japan's known for making things, but its finances has never been very world class. It's like Germany in that sense, but of course Japan is not even part of developing Asia. Because it's not a developing country. It's our only member country that is Asian but not developing Asia. But anyway, okay. I think that's a kind of a negative rationale for why we are doing this. But there is a more positive rationale, and it is this. I think if you look at Asia in the past, countries like Korea and more recently China and all these countries in East Asia, again, very good at making things, but with relatively backward financial system. But then one might argue, well, in that case, and I have heard this argument from at presentations in other places. Well, Asia grew so well in the past, despite having a relatively lousy financial system. So that must mean finance is not that important to growth, especially if you think about it now, because our growth, right? We are no longer growing at 10% per year. We are growing at 6-7% a year. So why are we doing this? Because this is why we are doing this as the special theme chapter. Because yes, Asia had a fast growth but relatively backward financial system in the past, but that does not mean Asia grew fast because of a backward financial system. What that means is we grew fast, we grew rapidly. This is really the key word, despite having a backward financial system. What that means is having a more efficient financial system that can give us higher growth. And a higher growth matters more now than it did in the past, because let's say, for the sake of argument, that an efficient financial system gives you 1% higher economic growth every year. That of course matters much more now when we are growing 6 to 7% a year than in the past when we grew by 10% a year. In other words, the growth dividend from a more efficient financial system, that actually matters more now than ever in the past, which is why, from a positive angle, we chose this financial sector development as this year's ADO theme chapter. Okay, so as I kept emphasizing, we are clearly growing at a slower rate than before. This is our average developing Asia as a whole. Of course, that includes Georgia, by the way. All of Asia's developing countries put together the growth is noticeably significantly slower since the global financial crisis boom broke out in the US, right, in 2008. So furthermore, that's the growth angle, that's the big angle, that's the main angle, but there are additional angles, right, that we look at. And it is the angle for equity, in other words, reducing income inequality, and there is also a stability angle, in other words, financial sector developing in such a way that promotes rather than harms financial stability. So these are the main theme here is how can financial sector development promote growth, but there are two important sub-themes, if you will. One is that of inclusive growth, in other words, equity, in other words, reducing income inequality. The other is that of financial stability. So to sum up, there are three strategic challenges that make financial sector development a critical issue now, an interesting issue now, a significant issue now more than ever. Again, the main one is sustaining growth, and there are two additional important ones, that is tackling growing inequality in Asia, and the third one. And the other sub-theme is, of course, maintaining financial stability even as our financial system develops. So let's look at some promising developments. Number one, this is ratio of bank capital to bank total assets, and it's a widely used indicator of health, right, of the health of a bank. And since the Asian financial crisis, right, which broke out in 1997, 1998, Asian countries' financial systems, in particular banking systems, and of course Asian countries' financial system are still dominated by banks, have become much healthier, as you can see from this diagram. But in terms of their total size, the relative size of our banking systems, whatever indicator you look at, whether you look at banking systems or the size of the bond market, we lag behind OECD, the rich countries, right? OECD is an organization of rich countries. This is a bank system deposit to GDP ratio. We clearly lag behind OECD, the rich countries, but actually, contrary to the conventional wisdom that Asia is financially underdeveloped, we are actually financially more developed than other developing regions. That includes Latin America, it includes Middle East, it includes Africa, and actually we are also financially more developed than emerging Europe, developing Europe, Poland and all these guys, right? In other words, European countries that are not rich, right, that are still developing. So that's somewhat in contrast to conventional wisdom. Actually, yes, we are financially underdeveloped, but only relative to the rich countries. Relative to other parts of the developing world, we are actually more developed, even relative to emerging or developing Europe, right? Poland, Czech Republic, all these guys. And that's also true for our financial efficiency. This is a measure of financial size, or the size of the financial system. This, of course, it's interest rate spread. In other words, the difference between lending rate and deposit rate, of course, that's a highly imperfect measure of financial inefficiency, but it is a widely used indicator of financial efficiency. Of course, we do better. We are more efficient than Latin America and other parts of the developing world, but less efficient than the rich countries. Now, having said that, we perform relatively well relative to other parts of the developing world, but there is enormous diversity, right? Heterogeneity within Asia. Of course, you have financial centers like Hong Kong and Singapore at one end, but you also have financially less developed countries, including, of course, Georgia. And the point of this is not so much Georgia versus Hong Kong, but just the enormous diversity, right? Enormous diversity within Asia. And this is one indicator, right? Liquid liabilities to GDP. That's a widely used indicator of financial depth. Another one is, of course, private credit extended by banks to GDP ratio. Again, here Georgia seems to be much more developed according to this indicator than this alternative indicator. But anyway, the point for both of these figures is not so much Georgia. Of course, since we are in Tbilisi, we highlighted this. The point here is that there's enormous diversity of financial development among Asian countries. So there's a lot of studies, tons and tons of hardcore econometric rigorous studies that look at the issue of, is financial development good for economic growth? And by and large, the overwhelming consensus, right? The overwhelming consensus from these studies indicate, yes, the answer is positive. In other words, financial sector development does seem to have a positive beneficial effect on economic growth. And some of these guys are world-class economists using the latest, most rigorous econometric techniques. But there are two big problems with this whole literature. One is simply this: financial sector development, the size of the private credit relative to GDP, or size of stock market relative to GDP. If you think about it, that is not really a measure of efficiency, right? It's a quantitative measure of quantitative size, right, of the financial sector. So that's one widely popular criticism of this whole literature. Another is this: there is this two-way causality. In other words, yes, financial development can promote growth, but the causality can go the other way too, right? Growth can promote financial development. For example, as a country grows richer, more and more people demand and get financial services, open bank accounts, right? And so as a country grows, that has a positive impact on financial sector development. So these are the two main lines of criticism directed at this whole literature. But in any case, these kinds of cross-country regressions, they do confirm that finance is good for growth. So we talked about these measurement problems, but there are some this of course does not take away that criticism. It does not do anything close to nullifying that criticism. This is just roughly suggestive diagram, but it does suggest that financial depth and financial efficiency are correlated. So what I and two of my colleagues at our research department at ADB, we performed some empirical additional econometric analysis. This is, again, this is not earth-shattering stuff. As I said, there are a huge amount of studies on this done by economists far stronger than us. But what we do is this: we do update the data to 2011, and our sample is fairly global, and we do incorporate country characteristic. For example, we distinguish between developing countries and developed countries and developing countries. We also add in a measure of financial openness, as well as fixed versus flexible, this foreign exchange regime. And then we use this GMM and econometric general method of moments, right? An econometric method that can help to tackle the endogeneity problem I talked about earlier. In other words, the two-way causality problem. Finance affects growth, growth affects finance. This econometric techniques helps to somewhat mitigate that potential problem. So without going into the econometric details, what are some results we get? Well, one is this. Yes, we reconfirm finance is good for growth. And that, well, this is somewhat more interesting, I would say. That positive effect is more visible in developing countries, and it's especially clear in developing Asia. And it doesn't matter which part of the financial system develops, because banks as the bank development has a positive impact on economic growth, but so does capital markets. Capital market development also has a positive impact. And financial openness has a positive impact, and foreign exchange regime is not important. But this is again just a minor answer, if you will, to this widespread criticism. Again, yes, financial depth is a very imperfect indicator of financial development. But again, there does seems to be a correlation, at least, between financial depth or financial size and financial efficiency, right? So yes, moving right along. Okay, so just so that you get, but you might, at this point, you might ask, well, how big is the impact to growth, right, from financial sector development? I mean, other than, oh yeah, you do run some econometric regressions cross-country, right? You put in 108 countries, put all these data for all these variables, some financial, some non-financial, so you get a positive impact of finance on growth, which is basically reconfirming the evidence from earlier studies, right, done by economists much more famous than us. But at this point, you might want to ask, well, how big is the impact? What is the approximate size of? Well, we do some of that, and this is what we find. For example, for developing Asia, if we increase this ratio of liquid liabilities to GDP from 65%, why did we choose 65 here for illustrative purposes? Because this is the mean, to 75%, that adds almost a 0.4%, 4 percentage points to average annual GDP per capita growth. So these are not earth-shattering numbers, but nor are they insignificant numbers. Okay, so now let's, so we looked at impact of finance on economic growth, but let's move on to perhaps what I think is a more interesting issue, and it is this. And here, myself and a friend of mine, a university professor in Korea, he's one of Korea's top macro guys. We went to grad school together at UCLA, so I still do a lot of work with him. But anyway, the issue we wanted to tackle is this, not the impact of finance on economic growth, but the impact of financial development on inequality. And if you think about it, I mean, forget any literature review. Even if you don't read a single paper on this issue, just think commonsensically, conceptually, intuitively. And if you think about it, the effect can go either way, right? If you think about it, because, well, let me explain. Financial sector development, right, can, it can clearly reduce income inequality if it leads to more and better financial services for the poor, right? Then the poor can borrow money, send their kids to children, then the poor can buy some farm equipment which makes their farms more productive, or the poor can buy a machine and open a small factory, right? Or not maybe a factory, but a small productive facility, right? So it can clearly, that raises the income of the poor, that raises their earning potential, that helps to reduce income inequality. But on the other hand, and this is more like the Thomas Piketty type of world, financial development, right, can make inequality worse. And here, think of New York or London, 2008, right, just before global financial crisis breaks out. All these fancy, sophisticated financial products or innovations, right, which even US regulators could not keep track of. What if they mainly raise the returns to capital? Of course, the capital, 1% of the rich, 1% of the population has 98% 4% of capital, right? So that's good for the rich, but it's not good for everybody else. Or as we all know, all these Wall Street, right? All these Wall Street, London fat cats, right? It Goldman Sachs and JP Morgan, all these guys there, it gives them higher pay, but with no obvious benefit for the rest of the society, right? The rest of the economy. In that case, of course, financial sector development makes inequality worse rather than better. And what is interesting is, so we run some econometric, we want to look, so this has to be resolved empirically, right? Because conceptually, it can go either way. So we try to tackle this issue empirically, me and my good friend Kwano Shin. And it's quite interesting because this is financial development. This is Gini, right? A measure of income inequality. Financial sector development reduces inequality, but only up to a point, after which further financial sector development makes inequality worse. And I think this is intuitively quite sensible result, plausible result, because here you have New York, London, US, UK, right? All these too much finance, right? As I said at the outset. But here you have countries like Bangladesh or Nepal, let's say, where financial development means more people opening a bank account, or in other words, poor people, poor Bangladeshis or Nepalis opening their first bank account and so forth, right? And gaining access to financial services for the first time. So, yeah, I just talked about this. But broadly speaking, what does this mean? It means this. Financial sector development does not, that's the key word here, necessarily reduce inequality. So what that means, obviously, for policy-making purposes, is that policymakers cannot just rely on financial sector development alone, right, to reduce income inequality. To the contrary, financial development has to be accompanied by active, conscious, concerted, deliberate government efforts to promote financial inclusion. Because if you think about it, it is not so much financial development that can reduce inequality, but it is financial inclusion, right, that helps to reduce inequality. So the best way to test this would have been, because we ran, this is what we did econometrically. Dependent variable is, of course, Gini coefficient, right, income inequality. And we have a bunch of explanatory variables, including financial sector development. So to test, because financial inclusion is the variable, right, that clearly has a much bigger impact, much obvious impact on income inequality. Of course, the best way would have been to add financial inclusion as one additional variable, right, to our regression. Unfortunately, World Bank just developed a very good database for financial inclusion, but it's a very recently developed database. It only runs 2 years, so we could not do that. We could not add financial inclusion as an additional explanatory variable. So what we did is this simple regression with just financial inclusion, and so again, this is inequality. This is a measure of financial inclusion, and yes, it does seem. This is not a very rigorous econometric. It's a very rough, simple, first order kind of a regression. But yes, it does seem like that financial inclusion is good for reducing income inequality. Okay. So last but not least, we look at the financial stability, because the big overriding theme, right, of this year's ADL theme chapter was how can financial sector development contribute to economic growth? And there were 2 sub-themes, as I said, right? How can financial sector development help reduce income inequality? In other words, promote more inclusive growth. And the third theme was financial sector stability, right? In other words, when financial sector develops, usually a lot of the times actually, it's accompanied by more financial instability, right? Or less financial stability, right? So because as a banking system opens up, government removes interest rate controls, then banks compete fiercely with each other. They cut interest rates and so forth and so forth. And that, of course, can sometimes lead to a lot of instability, right? Which is why, for example, Chinese authorities, right? Their policies are usually very sound and good, but they're very careful and gradual about financial sector liberalization because they're very concerned about potential instability. Okay? But in any case, why is financial stability important? Because financial instability, right, sometimes, often actually, leads to financial crisis, and that has very negative impact on growth. Remember what happened to Asia, East Asia, to be more precise, during the global financial crisis. All these high-flying countries, Indonesia, Korea, Malaysia, well, Philippines wasn't that high-flying. It was never part of the East Asian miracle. But anyway, Thailand, all these high-flying East Asian countries, East Asian miracle, right, according to a World Bank report that ironically came out just a few years ago, right before the Asian financial crisis broke out. Very high growth rate, 7%, 7%. And then after the Asian financial crisis, of course, it turned negative. In other words, economies shrank, contracted, and by significant amount. And this, of course, not just economic costs, but a lot of social costs, right? High unemployment, broken homes, and so forth. And we in Asia, so well, maybe not in Georgia, but we in East Asia remember this episode very vividly, and remember, and that is why, I mean, even to this day, there's certain mistrust of the IMF, right? For example. But anyway, but a lot of the point here is not IMF did right or wrong, but the point of all this is this, that financial instability can have huge costs in terms of growth, and also can have huge terms in terms of not just growth though, also equality, equity. Because this is long time ago already, but this is like a few years ago, right? Global financial crisis, Europe, 5-6 years ago, Greece, Ireland, Portugal, Spain, and then in many of these European countries, the countries that were hit the hardest, especially, unemployment rate doubled, and in some cases, even tripled. Of course, we all know unemployment is bad for equity because unemployment tends to hit the poor much harder than it hits the rich, right? Because the rich have savings, the rich have other capital that can help them tide over, right? During the times when they're unemployed, right? The poor do not. They depend much, much more on their earnings for their livelihood. So financial development for growth, I think, because I don't want to, because we have rather many slides, and let me just hammer the main points here. Financial sector efficiency, this is interest rate spread I talked about earlier, widely used measure financial sector efficiency, the difference between lending interest rate and deposit interest rate, and the private credit, right, as percentage of GDP. So when financial sector is efficient, that seems to increase credit availability. It also seems to lower credit cost. Here we have lending rate. So the higher this, the worse the financial efficiency, the more financially inefficient a country is, the higher the lending rate is, the higher the cost of credit is. And then and quite interestingly, what we find is, earlier in these regression results, I noted that finance has a positive impact on growth, but that impact is bigger in developing countries, and that in particular, that impact is biggest in developing Asia, right? So we have a possible reason for that here from this very simple diagram, and it is this. In Asia, in developing Asia, and here we do have Georgia and the other countries from outside, Tajikistan and Azerbaijan, other countries from outside East Asia. But anyway, here what you have is financial sector development. Countries where financial sector is deeper, more developed, they do seem to invest more. And this relationship between financial development and investment seems to be stronger among Asian countries than among the entire world. This is non-Asian countries. Blue dots are non-Asian. Here, just to get a clear picture, we just took out the Asian countries here. Okay. And then, of course, this banking sector, because Asian, as I said earlier, Asian financial systems are still dominated by banks, heavily dominated by banks in some countries. What that means is banking sector development is especially important. Again, countries with, this is just a plot of major Asian countries and major Latin American countries, right? Brazil, Chile, and other. Blue, Latin America, brown is Asia. And again, it seems like banking sector development, countries with more developed banking sector, countries that have larger banking sectors relative to their GDP, that have more developed banking sector, they seem to invest more, and countries that invest more seem to have higher GDP growth rate. Okay, so that comes out quite clearly. One thing that Asia lacks, these I will skip, is that we need more long-term finance in Asia. That's an area where Asia currently lags, and of course, one source of more long-term finance or long-term capital is bond markets. Again, here we do better than other parts of the developing world, but we are still significantly or well behind the advanced countries. So there's significant scope for bond market development, which in turn can help our long-term capital and long-term finance, which we need not only for things like infrastructure, but also for productivity, more productivity-led growth. In other words, innovation and all these kinds of, because innovation, if you think about it, requires patient capital, right? Because innovation, it's very random and uncertain. You don't know what R&D investment will result in a very useful commercial big hit, and other R&D investment will produce nothing. So R&D, innovation more generally, requires long-term capital because it requires patient capital because it's a random. And Asia, well, certainly middle-income Asia, countries, Korea certainly, but even countries like China now, they have to increasingly shift to a production, to a growth paradigm where they do more inventing themselves rather than just borrow technology from US and all these global frontier countries, right? So bond market development is certainly an area where there has been a lot of progress, by the way, in Asia's bond market development. And I think Kathy, right, will talk about ADB's role in helping Georgia develop its local currency bond market. But there's still a lot to be done. So just to recap here, I think it's important because in light of this huge heterogeneity, right, diversity of Asian countries, that the priority in financial sector development necessarily differs, right? For low-income countries, it's bank reform, right? I mean, let's not talk so much about capital markets for lower-income countries because there, the dominant sector, dominant component of the financial system is banks and will be banks for some time to come. So you need better, more efficient banks. But for middle-income countries, well, not just high-incomers like Korea, but also like countries like China and Thailand, there very much the focus, the growth paradigm is shifting toward investing a lot, saving a lot and investing a lot like Asia of the past, but now it's more changing toward more productivity-led growth where things like invention and innovation plays a bigger role in growth. So in those countries, long-term finance and things like capital markets, in particular equity markets, which are quite well developed in much of middle-income Asia, but also bond markets will have to play a bigger role. Okay, now financial access for inclusion. I think, as I said earlier, as I noted earlier, we have some empirical evidence that financial sector development does not necessarily reduce income inequality. So again, what that means is governments have to take active measures, concerted measures to promote financial inclusion, right? In other words, governments cannot just sit by, but they have to actually actively promote financial inclusion, both for firms, both for households as well as for smaller firms, right? And all the more so because unlike financial sector development, private credit to GDP, liquid liabilities to credit GDP. In terms of financial inclusion, Asia does not do that well. Asia, as I said earlier, Asia is financially more developed than other developing regions, but behind rich countries. That's not true for financial inclusion. This is rich countries. Asia, we do worse than Latin America. We do worse than Poland and these emerging European, developing European countries. And we are not that much better than Middle East. So unlike, in contrast to financial sector development, in the area of financial inclusion, in other words, how many of the poor households, how many of them have bank accounts? Or is it easy for small firms to obtain credit? In those measures, financial inclusion, we don't do so well. So it's clearly, and that's true whatever indicator you look at. It's true for formal bank account penetration, it's true for ATMs, it's true for commercial bank branches. So whatever indicator you, and it's also true not just for households, but also true for financial inclusion indicators for companies or firms. So this is financial access is low in many. Here's Georgia, by the way. This is adults with an account at a bank or other formal financial institution for the poorest 40% of the population. Okay. Of course, again, a tremendous diversity, as you can see. So how can Asian countries improve financial inclusion? Well, there's a lot of things they can do, which I will not go into, but fundamentally, it has to address two things: cost and risk. Smaller firms, they have to pay higher interest rate than larger, well-established firms. Is that a market distortion? Of course, it's not. From the viewpoint of banks, right? Apple, it's much less risky to lend to Apple, right, than it is to lend to a new small startup firm, right? So that's nonsense, right? But even so, there must be an effort. Having said that, so of course, if you look at from a simple economics 101 point, even from economics 101, of course, there's going to be different costs, different borrowing costs. Apple's going to get its loans much cheaper than a new Silicon Valley startup. But having said that, even so, there are a lot of things that governments can do to help reduce cost and risk, and thereby further promote financial inclusion, not just for households, but also for firms, smaller firms in particular. How about stability? Well, again, financial stability is important, so I'm not going to go into all of this, but just a couple of things to note. As I noted earlier, Asian countries, Asian financial systems, our banks in particular, have become much stronger since the Asian financial crisis. But there are still external risks. For example, quantitative easing and QE tapering, right? Unwinding of quantitative easing. Remember May 2013, Ben Bernanke, right? US Federal Chairman Ben Bernanke announced that he might start to wind down quantitative easing, right? In other words, he might begin to normalize monetary policy. And that caused a lot of commotion, a lot of instability in emerging financial markets, including here in Asia. All of these countries experienced quite sharp exchange rate depreciations. So there are a lot of external risks, especially related to unconventional monetary policy in rich countries, especially the US, and the unwinding or normalization of unconventional monetary policy in rich countries. But there's also a large number of internal risks, homegrown risks to financial stability in Asia. For example, China, a very big, right, and growing shadow banking sector, right? And also in many Asian countries, large and growing household debt. Of course, large and growing household debt is not in and of itself a bad thing. Of course, as an economy grows, people become richer. You can expect them to borrow to buy a car, borrow to buy a house, borrow to buy a refrigerator, taking on debt, right? Nothing wrong with that. But if it becomes too rapid, then that's the point where you start worrying about sustainability. Okay, so there's this Basel III, there's macroprudential policies, and there are all these various policies that can help Asia safeguard its financial stability. So let me just conclude by my presentation by going over the two or three actually key messages that emerged from this year's Asian Development Outlook. special theme chapter on financial sector development. So what is this? It's a positive message. Financial sector development, bank development, stock market development, bond market development, all of these things can indeed contribute to more inclusive growth in Asia. It can contribute to sustaining growth itself. It can also help to making that growth more inclusive. In other words, reducing inequality, right? But we also have to note that growth, financial sector will have an even bigger impact on growth if it, and I think this is a point that's quite relevant, right, for ex-Soviet countries, right? Although Georgia, as I understand, has moved significantly toward a more market-oriented economy, but for countries that used to be under socialism, like China, for example, the growth benefits of finance. In other words, finance will have an even bigger impact on economic growth if we move toward more market-based resource allocation. For example, in the case of China, they allowed limited entry of foreign banks, big private foreign banks, and that has helped to improve significantly, by the way, the efficiency and productivity of their big state-owned Chinese banks. And as I noted earlier, and this is absolutely critical point, impact on finance is not certain, it's a mix, it's ambiguous, therefore governments have to take active steps to promote financial inclusion, to help ensure that the poor households get financial access to financial services, and the same goes to smaller firms. By the way, financial inclusion, just one word about it, because I think it's a very critical issue, is this. Financial inclusion must be much, much more than a simple statistic. In other words, bank accounts for 1,000 people, right? Let's say a government, right, gives out bank accounts to very poor people in remote rural areas. And those very poor people in very remote rural areas do nothing with their bank accounts, right? Then, of course, that's not financial inclusion. That's nothing. That's just improving some stupid statistics called number of bank accounts for 1,000 people. So this last mile of financial inclusion to help ensure that the poor actually use financial services to improve their well-being or to improve it for productive purposes like sending their children to school, that is critical. That's what financial inclusion is all about, not just some stupid statistic. Okay, that's one thing. And secondly, regulators will be, there is this problem of challenge, right? There is this problem of challenge of finding the right balance, because on the one hand, you want financial stability, because we know how global financial crisis showed that even in rich countries, even in the biggest of all countries, America, financial instability can have devastating consequences, right? We learned that. I mean, we knew that before, but global financial crisis absolutely highlighted that for us. So financial stability is, yes, it's important for sure, but in the case of developing Asia, banks have to lend, right? And companies have to borrow, they have to invest. That's how Asia is going to grow more, right? That's how Asia's countries like Georgia and other middle-income countries and lower-income countries, upper middle-income countries, high-income countries have developed. That's how they're going to grow. So there is this real dilemma, right, facing Asian countries in terms of financial sector development. In other words, it's protecting financial stability because it is so important, but at the same time ensuring that financial stability does not mean that banks do not lend and companies do not borrow and invest and the economies grow. Okay? And one final note is that yes, financial sector development is important. It matters. It matters for our growth. It matters for our inclusive growth, and it matters for financial stabilities. But it's not a panacea. It's not going to solve every problem. And if you want to increase, magnify the impact of financial sector development on growth, there have to be complementary structural reform in other areas. For example, what I just talked about, banks lend more. Let's say banks are willing to lend more because of financial sector development They grow. You have bigger banks, more developed banks, more efficient banks. They want to lend more. But because of a very poor investment climate, a lot of red tape, a lot of corruption, entrepreneurs, there are very few entrepreneurs, right? And the few entrepreneurs there are, they don't want to invest, right? So of course you need this kind of business-friendly climate, or more generally a climate that is conducive for investment if you want to increase the impact of financial sector development growth. Likewise, similarly, if you want the classical example of poor people borrowing money to send their children to school, yes, that's a good thing. But if that's to become an even better thing, then of course you need better schools, right? Where those children actually learn something and learn some skills that will help them become more productive. So with that, I pass to our Georgia country director.
First of all, ADB is very active in supporting the financial sector. We have last year approved the first tranche of a 3-tranche program loan that's supporting, among other things, pension reform and capital markets development, as well as public-private partnership initiatives. And what this program lending does is provide an incentive for the government and technical assistance to the government to work in the area of capital markets reform, which includes working with the Ministry of Economy, Ministry of Finance, the National Bank of Georgia, to work together to figure out what are some of the impediments to developing your bond market, your stock market. And it involves working together with our other IFIs like World Bank, EBRD, the European Union, of course. And so we have this initiative. It was 75 million last year that we supported the government with, and we're looking at another 125 million, 170, what is it going to be? 125 million going forward. So, so this is one area that we're working in, and pension reform is another, because you have, of course, your universal pension system, but there's a need to develop a contributory pension system, which will help take the burden off the government and put some of the responsibilities for pensions on the workers and employers, and so that you have, over time, developed a system that is similar to what you have in other countries, like in the European sphere, as well as in the United States, Australia, and other places. So this is going to be long-term efforts to support the government in these initiatives, because it takes a lot of education of government parliamentarians, government officials, and then a lot of education of the public, because they need to understand the benefits of having a vibrant pension system. And one area is to develop, as Dr. Park said, the long-term funds for investment. And pension funds provide a very important source of long-term money to invest in infrastructure and invest in cities and things like that. Then going further here, I guess, this was, and then this is some of the lessons that we've learned from all of these bond issuances. And I think an important one is that we can, with our other development partners, be key to catalyzing the development of a regulatory environment for bond issuance. And we can also help to provide sources of local currency monies for the financial institutions. And that brings us to what we did with our recent bond issuance. It was 100 million lari. It was issued for 3 years. It has a 3-year tenor, till February 2018. It was issued at, priced at par with a floating rate that is set to the National Bank of Georgia's 3-month CD rate. The lead underwriter was TBC Brokerage, and the proceeds, and this I think is the most important aspect of this, this has two benefits here. Issuing a bond, when ADB, because we have our AAA rating, when we issue a bond, it's a very good bond as an investment vehicle, and it sets a benchmark for pricing, and that has value. It tries to lengthen the tenor of bonds, and I think prior to this, there weren't, I think EBRD had issued a bond and IFC had issued some bonds, and I think, so with this issuance, we're up to 3 years, which was good. I think the earlier issuance the first issuance by EBRD about several months ago was for a shorter tenor. I think it was only 2 years, George, wasn't it? But the most important aspect is where the proceeds of the bonds went to. And in this case, it went to a loan to TBC Bank for on-lending to SMEs. And this made the newspapers, probably more so than our bond issuance, was that it was one of the largest local currency loans that an IFI had made to a local bank. And we find this, the important aspect of this is that it enables your companies and your banks to borrow in local currency rather than borrowing in dollars. And that's very important to reduce the overall risk of currency on this economy. And so this is what we'd love to do more of. Of course, the way we look at bond issuance is we don't issue just for the sake of issuing a bond. We have to have a demand for it. So we need to have a local currency project that we want to lend for. And in this case with TBC Bank, we had a great one because the proceeds went directly to the bank for on lending in rural areas and to SMEs. And we have a very good relationship with TBC Bank and a very good design of this loan program where we work with the bank to encourage these monies to go outside of Tbilisi and into the areas of the country that really can benefit from this kind of financing, and especially benefit from local currency financing rather than dollar-denominated debt. So, and then this project was, so we hope we'll do more of these, and I understand we do have some more in the pipeline, and we're eager to look for other opportunities. And I'd like to ask some questions of Dr. Park about where he sees other opportunities for using local currency financing and where we've seen them in other countries in Asia. That might be a good example for Georgia. Okay, and thank you very much on that.
When I first went to Asia, the first destination was Korea, and when I went to the country, I see all these new cars, new buildings, and everything is high tech. But then the next day, I went to the bank, and I spent about 1 hour to open the bank account.
Right.
And the same thing, actually, the same amount of time I spent in China. So, in Georgia, I've opened many bank accounts, and it takes around 10-15 minutes. I think before moving to this, big changes like bond market development and others, I think it's better to develop this, customer, speed of development, the speed of service in the Asian banks. That's what I experienced personally. Maybe you know it better. And I can imagine taking loans from those banks.
No. I could not agree more. I think even in countries that are middle income and upper middle income, and where capital market development, in particular bond market development, is a higher priority, you're absolutely right. Developing the capital markets does not mean or must not come at the expense of further development of the banking sector and making bank more efficient, and even simple things like reducing the amount of time.
And
Simple but important, I might add. Things like reducing the amount of time it requires to open a bank.
You know, I wanted to make a comment because
Yeah.
early on in your presentation, I thought to myself, there is a difference here. If you look at the real sector in Georgia has a problem.
Yeah.
Okay, so it's just kind of the opposite of what we were talking about with the financial sector being, the financial sector here is relatively developed compared to the real sector. So it's just the reverse of what you see in parts of Asia. And I think that's a challenge and
You mean here the financial sector
is
is
far
more,
oh, definitely more advanced than the real sector,
but-
right?
But problem is, it's not, problem is though, it's not, sorry, you're about to say something.
Yeah, what I was trying to say, I didn't think the bond sector is that developed into.
Oh, the banking, no, the banking sector, the financial sector in
Finance.
general. It's more well-developed as compared to the real sector, which is manufacturing.
Yeah.
And that's the struggle to get the manufacturing
Okay,
going here.
okay, Kathy, I think from what you've told, what's your name, sir? Coca, right? Coca told me about how much easier and quicker it is to open a bank account here than in much richer Korea, for example, or what you're just saying. I mean, that's fine, but so you're saying Georgia financial sector is pretty well developed, but I mean that's fine, but it's not. I mean, and developing a more dynamic manufacturing sector, that's a different challenge. I mean, having efficient services is fine, but unfortunately for Georgia, right, it's not, and realistically, it will never be the UK, right? I mean, where financial services are not only well developed, it's the main national industry. I mean, UK is not very good. British people not very good at making things, but in terms of finance, right, they're world class, and a large part, it's like the first or second biggest global financial hub, right, the city in London. So I mean, it's good for Georgian people, citizen, when you open your bank accounts and so forth, but it's not how, realistically, it's not how, even as a regional financial hub, I don't think it will happen. I mean, it's not even going to, cannot compete with the Dubai, right, for example, even at a regional level, forget the global level. So it's good for convenience, it's good for making life simpler when you go to a bank and so forth, but it's not going to be something that, a major source of livelihood, let's say, for the Georgian economy. I don't think, yeah, go ahead.
Like with the development of this new technologies and everything,
Yeah.
do you think there is a lot of space for new financial capitals or regional financial capitals or these financial hubs that will be like for each region or something like that around the world?
You know what, to some extent, right, I think in terms of both transportation and services, especially financial services, there is already a hub here in this part of the world, right? And it's Dubai in terms of finance and airline transportation. But I think it has to be much more, there has to be higher level of connectivity. So I think, look, I don't know how good the Turks are at finance, and to some extent this is kind of a national advantage. For example, in my part of the Koreans and Japanese, we are very good at making things, not so much in finance. And in Europe, for example, Germans, right, they make world-class cars, they're not so good at finance. So I don't know how good the Turks are in finance, but but in terms of connectivity, at least because of Turkish Airlines, and I think flies to more cities than any other airline in the world now, and it's certainly one of the key hubs in this part of the world. There's a potential there, but of course but they have had a long history of a controlled or repressed financial sector, and that legacy will be very difficult to overcome. But at least in the terms of connectivity, I think there is scope for a second financial hub in Istanbul, but much more realistically, Dubai, right? Even up to the Caucasus will dominate the proceedings for a long time to come. But to the more general question, this IT and all this new technology, you can transfer money in 0.2 seconds now, right? Even from 10,000 kilometers away. That actually reduces, right, the need for regional hubs rather than increases the need for regional hubs. So I think
that was the point of the question.
What?
That was the point of the question.
Yeah. So in that case, it's definitely going to be regional hubs will lose out. I mean, will be less important, I think, because of that's the impact of technology. But there are these niche products, right, that some financial sectors can develop. For example, Kuala Lumpur, right? I mean, Georgia also has a small Muslim minority, right? In fact, some ethnic Georgians are Muslims too, right? Anyway, this sukuk, right? In other words, Muslim financial products, and Kuala Lumpur, right, out of nothing, through sheer government effort, has become a major hub for these, what is it called? Sukuk, right? Sukuk products, and also, and there are all these, I was about to say something, but I forgot. But there are these specialized products, and I think that's the way. That could be the main. Oh yeah, here we go. Dim sum bonds, right? Hong Kong and its dim sum bonds, renminbi, yuan-denominated bonds, right? Hong Kong was a pioneer there. So I think in these type of specialized niche products, there's some scope for regional financial centers to expand and grow, but technological progress, IT in particular, that weakens the need for regional hubs, and it gives an even bigger advantage to New York and London, I think. Yeah, go ahead.
You mentioned certain distrust that Asian countries have for the International Monetary Fund since the '98 crisis. There has been a lot of talk, and still, some about the alternative, creating an alternative to the IMF, or some structure that is focused more on Asia.
Yeah.
Dominated. So, what is your view on that? Whether it is necessary, whether it would be somehow beneficial, or how does it fit into the?
Okay. That's an interesting question, but I don't know how familiar the audience is with ADB or what we do, but this is strictly personal view, and Kathy and George may or may not agree. But there's this new bank called AIIB, right? And I think it's a great thing, because that's a personal view, but because U.S. has been pressuring China to do more soft power, right, rather than harassing smaller countries in South China Sea and whatever it's been doing, right? So, but if an infrastructure bank, right, which Asia desperately needs, if that's not an example of soft power, I'm really puzzled. What is soft power? So, to me, the U.S. Tooth and nail, let's say, opposition to AIIB was quite puzzling, and I think that's. And I felt that way already when this AIIB first came out in the news. But then I think that's the more sensible, opinion. For example, an Economist article on precisely this issue, U.S. opposition to AIIB, it was just last month or so, and that actually closely echoed what I was thinking. I thought AIIB is a very necessary, and it's a very good example of China using soft power instead of bullying Vietnam and Philippines, or whatever it's doing, whatever unpleasant things it's doing in the South China Sea. So, with respect to your question, though, AMF is not going to happen. I mean, I think I think there will be further reforms within the IMF and World Bank. Asia's voice will become more proportionate to its economic weight. It's just a matter of time. And I think these kinds of development, like AIIB and so forth, will force or pressure the Western countries to move more quickly rather than slowly forward to implement these long overdue reforms at the fund and the World Bank. Yes, go ahead.
What do you think about the digital currency like Bitcoin?
Well, that's a great question, but to be honest with you, I'm not very familiar with that. But I mean, but what I understand is one sticking point, one major barrier, right, is the security issue, right? But also from my limited understanding, I understand there has been a lot of progress in improving the security of the Bitcoin. So I think, but from an economist's point of view, I think it's a very impartial currency, right? And it's not a currency that really depends on the self-interest of governments, right? So in that sense, I think it can be a positive development as long as that the privacy issue is settled more forceful, more in a more satisfactory way, because once you get the government out of this and their desire to pursue inflation when there's recession and these kinds of politically government self-interested motivated monetary policy, Bitcoin is free from all that, right? So I think in that sense it's a positive development.
With regards to the previous question, the introduction of organizations like AIIB,
Yeah.
is it going to decrease the role of ADB or is it going to supplement the financing?
No, I think again, this is a strictly personal view. I think this question might be better put to our president, who's many levels above me. But having said that, personally, I don't think it will diminish our role at all. I think we would have to do some reorientation rather, because yes, we will continue to be a infrastructure bank. I think most of our loans, right, to put it simply, will be to build power plants and roads, and so what we're doing right now and what we've been doing the last 50 years, we will continue to do that. But I think one other than just sloganeering, one serious way we will have to move is to become more of a knowledge bank. I mean, of course, and producing good policy relevant knowledge, because as things stand right now, talked about the Asian Development Outlook, right? I gave distributed small highlights packet, but I mean, ADO is our answer to World Economic Outlook, right? But it has a realistically, right? And I don't have any reason to speak ill, to belittle ADO, because that's my bread and butter, ADO. But we have a long way to go before we reach the analytical rigor and the external respect, let's say, or recognition of a World Economic Outlook. So I think one way which we will have to move is to become more of a knowledge bank rather than just sloganeering and catchphrase, and to produce more and better and policy relevant, not just hiring some consultant here and there, but to produce better analytical research that our developing member countries really listen to and can be beneficial to them. That's one way, but another here, that's one knowledge bank, more of knowledge, that's one way. But the other way is instead of infrastructure, there's certainly more scope for us doing the social protection and social safety nets. But But realistically, the scale of loans, right, the amount of loans in those areas, they're important, are quite limited. I mean, you don't have a multi-billion-dollar social protection loan. I mean, but investing more in these areas, lending more in these areas, I think that's certainly an important reorganization direction for our bank as we enter a world in which there are not one but two infrastructure banks in the Asian region.